board Deepak Gupta, Head of Research and Senior Fund Manager, Equity at JM Financial Asset Management. Deepak, critical day to have you. 2% lower on the Nifty, and you're seeing some real pain all of a sudden. If viewers or investors were to feel that the pain was behind them, today the pain is even more pronounced. What should one do in a market like this? Should you wait, or should you not catch a falling knife, or is this the opportunity to buy?
Firstly, thank you for having me on the channel.
Great having you.
In our view, currently the market is going through a risk-off environment where globally all the risky asset class are declining in a meaningful manner. India is not an exception to that, and we've seen something similar play out in 2022 when the Ukraine-Russia war commenced. And typically, if one would have held the nerves and would have bought during Feb to June 2022, they were handsomely rewarded post that. So we do think that while the correction is severe and the entire world is facing the brunt of it, at some point of time this event will pass. And in hindsight, this could look like an opportunity where one should have added the allocation towards equities, and which is what we advise our clients that they should hold on to their nerves and continue with their SIPs and keep looking to add at lower levels and keep averaging out their cost, which will eventually help them in a medium to long term basis.
Point taken, Deepak. What should you add at this point today?
So presently, we're quite optimistic on the healthcare sector, especially on the domestic pharmaceutical segment, given the fact that there is a meaningful opportunity being launched in the next fortnight, where the GLP-1 drug will go off patent, and there are various ways to play that event, and that can be a meaningful contributor to earnings for a lot of pharmaceutical companies in the coming quarters. Apart from that, even healthcare segments such as hospital diagnostics are meaningful opportunities where the demand is extremely robust, and they have been able to demonstrate strong earnings growth along with reasonable top line growth as well.
Okay. So hospitals, healthcare, pharma is where your tilt is. What is it that... Deepak, in a market like this, there'll be a lot of investors who would have probably be 95% invested in equities. Of course, you stay the course, right? But these are also opportunities to reallocate from pockets or places which were, for example, overvalued or still continue to be overvalued, to those which are relatively looking very, very cheap. I'll give you an example. A simple HDFC Bank has moved down 20%. So just simple ideas where you could probably start looking at upsides. But I'm trying to first understand, what are the pockets that you sell in a market like this if you are nearly fully invested?
So typically, in a market like this where one is fully invested, one should look to reallocate their funds from the high beta segment towards the low beta segment to make the portfolio more defensive, and hence segments which are directly impacted by the events which are unfolding, such as increase in crude oil prices, dependent on LPG gas, where we are facing severe shortage currently as a country, because these segments will take some time to recover. While looking at the second order and the third order impact of the event that has played out, and look to add in segments where it's still far-fetched, for example, financials, which have taken a major amount of beating in the last couple of weeks, largely on account of the fact that there is view that there could be higher duress in the MSME segment, which could lead to increased delinquencies in the asset quality. That is a bit far-fetched currently, because one doesn't know till how long crude oil prices will remain elevated. But financial is one segment where one could look to increase the allocation, given that the segment has got meaningfully hit by underperformance in the last fortnight.
Okay, so tilt towards financials. Deepak, I wonder how you look at some of the other pockets. Defense, for example. War is always good for defense, but clearly defense counters have also come under pressure. Just my guess is it's a sentimental knock. Do you go out and buy on dips some of these names? And if so, do you have maybe a tilt to or a preference? Larger PSUs, I know you can't talk names, but maybe larger PSUs, is that your tilt? Are some of the smaller names your tilt, faster growth, etc.?
See, again, as defense as a segment should be present in one's portfolio, and one should be a bit overweight on that segment, given the fact that over the last 4 years, we've seen multiple skirmishes and wars taking place across the globe, and typically the segment will benefit out of the events which are unfolding at present. In terms of allocation towards names, one should look for where the earnings are more stable and resilient, and not really dependent on any specific event per se, irrespective of whether what their market cap bias would be, and companies where the leverage is reasonably limited and is able to generate meaningful free cash flow. I think those are the kind of defense companies one should look to add in their portfolio. And as you rightly said, there has been a sentimental knock on many of these companies currently, and that could be an opportunity for one to add their positions into these names.
Okay. Deepak, I wonder with regard to consumer, how are you playing that theme? It may already be part of your portfolio. It may be something which looks even more attractive now. Give us a sense of how you're playing it.
Sure. So in terms of consumer, our bias is more towards the high-end segment of the consumer discretionary, wherein which is less impacted by what is currently going on in the market. Also, one should be conscious about the fact that higher crude oil prices implies higher packaging, logistics, and transportation cost. So therefore, there could be some impact on the margins for many of the consumer staple companies. And anyway, these companies are trading at meaningful and are trading at high multiples, and they're not able to demonstrate strong earnings growth. So that's a segment where we are not very optimistic on. We are more optimistic on the consumer discretionary segment, where there are premium products being available. And as we have seen in the past 5 years, that India is tilting towards the high-end segment of consumption, where the high-end products do better than the mass products. Hence, I think companies which are catering to the high-end consumption segment, those are the segment of companies where we are focusing on.
Interesting. How do you look at new age tech and the like? Because what we're seeing is for example, Eternal, Swiggy, seeing significant corrections there. I'm trying to understand whether you're finding it as a really compelling buy at this point.
Sure. See, for new age companies, we have a very simple yardstick that whether it's new age or old age, the company should have sights towards profitability. The company should be able to demonstrate that they are profitable in the near term future. And companies which are lesser impacted with the advent of genetic AI, those are companies where we would be more biased towards because of what is happening on the AI side. A lot of things which are taken right now for granted may not, their business model may not be operating in a similar manner once AI becomes a more common feature in their product offerings. Hence, one has to be slightly mindful when one is taking allocation in many of these new age companies, though they may have meaningfully corrected from their peaks. Still, if they are not able to show that they can be consistently profitable, one should be mindful about holding a meaningful position in them.
Okay, Deepak, thank you so much. Critical day. You've come in and given us your perspective with regard to what to do. Be calm, be patient. Don't get into or sucked by the fact that the market has fallen. Thank you for coming in and speaking with us.
Thank you so much for having me. Appreciate it.
All right, what we'll do is we'll slip into another very short break, and thereafter it's going to be an action-packed hour because now we've seen a significant correction and the bears have really taken grip. How does the last hour play out and how does next week really start off? Is this really the dip everyone was waiting for? We'll speak about that and more on the other side. Stay with us.